Hello students, welcome to my class. This is Professor Vincent Usaya and this is part 4 of chapter 23 presentation. This is where we left off in part 3. We are talking about how to determine the receipt from customers. So underneath this slide, take a look at what happened here. Underneath this slide, yes, net income. Again, we are using the indirect method. The only difference between the indirect method and the direct method is the operating activity section of the statement of cash flows, not the investing or financing. So in determining the cash inflows, the net cash inflows or net cash outflows from operating activities, that is where the difference comes about. So like we discussed earlier, we are starting from the bottom of the income statement, hence we call it indirect method. Actually, that is for your exam, for theory. So net income is $34,000. Now look at what happened. $36,000. Accounts receivable went up by $36,000. So we are going to decrease net income by that $36,000. Why? Because an increase in accounts receivable, like we said, result in increase in sales revenue and increase in net income without a corresponding cash inflow. So we need to back out increase in accounts receivable. Now let's take a look at the accounts payable. Accounts payable went up, but we are adding accounts payable increase. Why is that? Let's take a look at the increase in accounts payable analysis. So what happens? Take a look at what normally will happen. If we have an expense or if we accrue for an expense, let's take rent expense. So we debit rent expense for $3,000 and credit what? Rent payable for $3,000. Now, it is very important for you to catch this. So we have an expense, but we don't have cash outflow. So what happens? This expense decreases the bottom line, that is the net income, but in actuality there is no cash outflow. So when there is an increase in payable, in this case payable goes up, that increases expense, which decreases net income without cash outflow. So therefore, to make that adjustment, we need to add increase in accounts payable. I know it is very likely that you are listening to this, you are going to be rolling your eyes and say, what is that? That is how it should be. This is one of those things you need to think through very carefully, because take a look at what happens here. Let's assume, like the example we just that we just illustrated. Look at this: rent expense, rent payable $3,000. Let's take a look at income statement. Income statement, revenue $10,000, expenses are $3,000. Let's assume that revenue is 100% cash. Expense is non-cash, right? So net income is what? $7,000, right? This rent expense decreases the bottom line, right? And look at, rent payable goes up. The increase in rent payable results in an increase in rent expense, which decreases the bottom line without a corresponding cash outflow. So for me to know how much cash that we receive from operation, look at, I'm using the indirect method. I start with what? Net income for what? 7,000, right? Then I add what? Increase in accounts payable of what? 3,000, and that will give me what? The cash that I received, because look at this. This is 100% cash. This is not cash. Even though my net income is 7,000, then I actually receive what? $10,000 cash. So that is where we are adding increase in accounts payable to net income. Because when accounts payable goes up, That increases expense, but we are actually not spending cash. Because don't forget now, expense decreases bottom line. Now, look at this. Accounts receivable increase is a subtraction because accounts receivable this week relates to this, while accounts payable relates to this. This is minus, this is plus for income statement computation purposes. So that is why an increase in accounts receivable is a minus, while an increase in accounts payable is a plus. Interesting, isn't it? You have to think about that. Now, moving along, let's take a look at step 3. Step 3 is easy. That is determining net cash flows from investing and financing activities. That is not very challenging. So take a look at what happens. I already talked about accounts payable, talk about increase in accounts payable, talk about increase in accounts receivable, and increase in accounts payable. We made those adjustments. Look at it. Easy. We issued what? Common stock for 60,000, right? When we issue common stock for 60,000, what is that? That is what? Cash inflow. So we report $60,000 under financing, issuance of stock. Then look at retained earnings. We are told that we paid $14,000 dividend. That is cash outflows under financing. So look at this. You do the math. Bingo. The net increase in cash is 49,000, and cash at the beginning of the year is 0, and cash at the end of the year is $14,000, which is consistent with the amount that was reported on the balance sheet. Now, this is very important. Why do we need to split the statement of cash flows into 3 categories? Operating, investing, financing. This is one of the reasons. Listen to this very carefully. As a company, most of your cash should be coming from where? Your operating activity, because that is the reason why you are in business. If most of your cash is not coming from operating activity, then sooner or later there's going to be trouble. Just like you and I. In my household and in your household, most of the cash that we spend should be coming from our regular job. If most of the cash that we spend is coming from going to pawn shop to go pawn something in the pawn shop, sooner or later you are going to run out of pawning stuff. Then it is a financial disaster. Same thing with companies. Most of their cash should be coming from operating activity. If that is not the case, then it is a sign of potential trouble. So, indirect method, another example. All right, indirect method. We start from, in terms of determining the cash flows from operating activities, we start from the bottom of the net income. Here, the net income is 90,000. We have to make adjustment to reconcile net income to net cash provided by operating activities. We talk about this, depreciation expense. Depreciation expense is a non-cash expense. There's no cash outflow, but it was subtracted from net income, so we need to add it to it. Loss on sale of equipment. This, I think we are going to talk about this in a minute. Loss on sale of equipment is added to net income because there is really no corresponding cash outflow when it comes to loss on sale of equipment. Why is that? Because loss on sale of equipment is determined the difference between the book value and the cash received. So the cash received and loss on sale of equipment are 2 different things. We are going to talk about that in a minute. So moving along, let's take a look at decrease in accounts receivable. We talked about that. The increase is subtracted, decrease in accounts receivable, the opposite effect. All right. Accounts payable, we talked about that. And bingo, we have 208,500 in net cash provided by operating activities. Now, let's take a look at the direct method. And we are going to use this information to illustrate the direct method. So here is the situation here. Sales revenue 840, operating expenses 624, depreciation expense 60, loss on sale of equipment 26, income tax 40, net income 90. Now, look at what we have here. Assume accounts payable relates to operating activities. So let's take a look at how the direct method works. The direct method starts with the beginning of net income. Indirect method starts with the bottom of net income. So, look at the first thing we need to do here. We are going to prepare the operating section of the statement using the direct method. Now, the first line item on the income statement is sales revenue. So the sales revenue here, look at this. The sales revenue here is $840,000. The question is, of the $840,000 sales revenue reported in the income statement, how much of the $840,000 is cash? Again, we are starting from the top because this is direct method. So this is how we determine that. Listen to this carefully. We have two approaches. The first approach is the formula approach. And the second approach is the T account approach. Whichever you are comfortable with, by all means, use that. So let's take a look at the first approach. He said here, to determine the cash received from customers, look at the formula. It's sales revenue plus what? Decrease in accounts receivable or minus increase in accounts receivable. What does that mean? Remember, we just talked about the fact that when accounts receivable goes up, that does not translate to cash inflow, and that is part of sales revenue, so we need to back it up. When accounts receivable goes down, that means we receive more cash in that year than the cash that is reported in sales revenue. So we need to add decrease in accounts receivable. If that doesn't make sense, before it makes sense to you, just memorize it, okay? And just get the question and just move on. Somewhere along the line, it will. All right? So let's work this out. Now, let's take a look at the sales revenue. The sales revenue is $840,000. What happened? There was a decrease. So let's go back. Look at accounts receivable. What happens to accounts receivable? There was a decrease of what? $22,000 in accounts receivable. So we are going to add the decrease in accounts receivable to the sales revenue of $840,000, and that will give us $62,000. So that is one approach. Let's take a look at the second approach, which is using the T account. You plug in the numbers that you know. We are analyzing accounts receivable because accounts receivable is a sister to sales revenue, right? So we know the beginning balance is $59,000, we plug that in. We know the ending balance is $37,000, we plug that in, right? Then we know that the revenue is $840,000, we plug that in. How do we know that? Because we already know the revenue. You debit what? Accounts receivable, you credit sales revenue. So this amount was debited to accounts receivable. Now, how do we know the cash that we actually receive? So I think this would be a good point to wrap up the fourth part of this presentation, and we'll continue from here.